Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets.
Kansas City wheat. The low water mark of the 18th of August last year was pivotal to the construction of what happened next in this market. Back then, the market failed to break down through the neckline, currently 832, which is highlighted in bright red on my daily chart of the small but highly influential October 2021 to January 22 head and shoulders top. Please bear this neckline in mind, as it will crop up again later on. Anyway, the market chose back then to construct a new pattern, a bull channel. Prices moved up and penetrated the 957 area, the gateway to a congestion area between 957 even and 1001. Rising and pushing up over the long moving average, currently at 952, plus a lot of old congestion made up from 2011 and 2012. However, the addition of the long moving average on top eroded the rise, and in early October the market broke down and out of this bull channel. A choice now came for this market at this point. This is a parallel to what we saw in Chicago wheat futures. Much like Chicago wheat, though it's not a complete duplicate, this market had two avenues. The market chose what I described in my commentary from a few weeks ago, and I quote, the straightforward move down with potential targets for the break of the bull channel. Thus, we have a primary target X down in the 903 zone, whilst the secondary harder to reach target X1 is way down below in the 759 zone. End of quote. In late November, prices reached the primary target at 903 and continued lower, all the way down through the 50% Fibonacci line of the August 2020 to May 2021 move at 900, the 50% Fibonacci line of the September 2019 to May 2022 move at 881, the 2013 high and the 2014 high at 855. 2013 high was 862. But by then the prices had hit the bright red trend line once again, the one I mentioned earlier, the neckline of the small but highly influential October 2021 to January 2022 head and shoulders top, and things stopped. We saw some rises, but they were eroded by the resistances, and the market kept dipping back to the red neckline until 2 weeks ago. You see, by then the market had edged through the October 2022 to date downtrend, currently at 817, a 5-pointer downtrend that I have highlighted in bright green. Thus, the market had a choice of pushing down through the red neckline or the green downtrend, and it chose pushing up through the green trend line. Yet all this has not been easy after choosing this route. You see, once again the market has gotten itself stuck in the overhead 855 to 881 congestion area, well, until today, as well as punching up through the short medium moving average, currently at 857. This move up was all initiated by the weekly key reversal up made 2 weeks ago. This now leaves the following questions and observations. Will target X1 in the 759 zone, will it be still a temptation enough for a move lower? Not looking that way at the moment. It's looking remote. Alternatively, will the market base out here and start a move higher and possibly make the mid-June today action, maybe even the May today action, into a very large double bottom? This may happen, but I'd look closely at the two nearest 50% Fibonacci lines overhead. At 881 and 900, plus the almost flatlining medium moving average. They're to be the first line of defense in any such attempt. If these falter, if we see the market close consecutively over it, then we have a pretty empty zone ahead until the long moving average. And that's quite a distance up there, just under the 960 area at the moment. Minneapolis wheat. Back in early September last year, there was the start of a new bullish pattern, a bull channel come ascending, expanding wedge pattern, which I highlighted in dark blue on my daily chart. The rise here was slower than in the other grain markets. In early October, the market broke down through the lower bull channel line, and giving us the same choices that we've seen both in Chicago and Kansas City. The market chose a straightforward move lower with potential targets. Thus, we had a primary target below, quite a way below actually, compared to the other grain markets, in the 883 zone, with a secondary harder to reach target X1 down in the 840 zone. This market was, as I said, slower, and so it was that prices only managed to reach the primary target 2 weeks ago. However, after reaching it, the market shot straight back up with a weekly key reversal up that also punched up and out of the upper bear channel line, currently at 895, of a bear channel that had been constructed since the break lower back in October last year. Interestingly, this was done with a weekly key reversal up 2 weeks ago. You can see this in the this as the upper bear channel line is highlighted in bright red on my daily chart, and it was a 3, almost a 4-pointer downtrend. It had the additional reinforcement of the entwining, declining short-medium moving average within it, currently at 912. We're right now clearly over the downtrend, but prices are still battling the short-medium moving average, though I seem to have some success today. In anticipation of this move, I put forward the following scenario some 7 weeks ago, and I quote, "Is there a possibility for the whole of the July today action, possibly even the action from June today, to be a very large double bottom? It will very much depend, I suspect, on whether the market will drop down to target X." This was the old primary target which had already been achieved in the 840 zone. "And what it will do once it manages to get there. But it will become a more significant question as the weeks go on." End of quote. Okay, so this question is now still open, as we have neither, well, until today, moved higher nor edged lower, instead choosing to edge sideways. This, the idea of a very large double bottom, is still out there. But we have significant resistance overhead, starting from the 50% Fibonacci lines at 955 and 974. Meanwhile below, well, apart from the broken upper trend line, we also have the whole of the December last year and January this year action as support, as well as congestion around the 2017 high at 868 and the August low at 861 3/4, plus the whole idea of a very large double bottom to deal with. Do we really wish to go that way? This is the next real question. It's maybe being answered today.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.